Good morning. Another choppy day on Wall Street. And I thought we'd talk a bit this morning about why so much chop and so much fear and things going on. There was a lead article in the Wall Street Journal this morning about a money manager hedge fund, Bill Wang, pumping up the values of his fund from 10 billion to 160 billion, using a lot of leverage. And charges have been filed against the gentleman and his chief financial officer. I'm not sure exactly what they did that was illegal. Maybe they misled some lenders because they leveraged everything to come up with an amount that they don't even come close to managing. And their positions in these stocks began to unwind as the likes of Morgan Stanley and Goldman Sachs realized that they were lending against maybe a fictitious portfolio. And the Wall Street Journal is blaming yesterday's 800-point decline on this debacle because the Morgan Stanleys of the world had to sell out of these positions, these stock positions. I don't know, but it's part of the game. And what I want to explain is when we get into Federal Reserve tightening of the money supply, it usually leaks out in the form of some failure. Long-term capital management a few years ago, Continental Illinois before that, where there's some leakage in the lending and borrowing process that goes on, and then there's fear of collapsing. You know, in a world where we have derivatives, they're like options on a lot of assets, but the derivatives steer into the trillions of dollars, and one party owes another party something that's part of a derivative transaction. Then you get into counterparty risk, and you get into the fears that somebody in this solid chain breaks and the chain doesn't hold up. And that's always the fear around a bottom or within a bear market that threatens liquidity. And that's kind of what's starting to smell. That's kind of what's showing up on Wall Street, because we do have a Federal Reserve that has promised a tough interest rate policy to get after inflation. So let me cast things for you so perspective will allow for a greater understanding of what's going on, even though nobody really knows what's going on. Okay, we have had about 14 years of zero interest rate policy brought on by Ben Bernanke at the Fed and doubled and second and tripled by Janet Yellen at the Fed. And in those years, they ignored tight credit conditions. They ignored overvaluation in some markets, home markets and whatnot, and just adhered to a policy where the Federal Reserve was going to keep interest rates at zero, no cost of money. That alone is a fairy tale market. There's always a cost to something, and there's always a cost to money. But this predominance of zero interest rate policy for about a dozen years, call it safely a dozen years, has created very low interest rates where people deposit money in a bank and they can't even get 1% on that money. So what do? They seek other alternatives, and there's been a search for yield around the place. Interest rates create all valuations, meaning that all valuations come from an interest rate calculation. So when you have the market paying 2 times a 2% cap rate on a commercial building, when you have the price earnings ratio on stocks in the 20s, 21, 22, 23 times, and for the richest stocks, the highest growing stocks, 100 times earnings, is not unusual. When you've got these kinds of things going on, along with interest rates that are below 1% for a 10-year bond, it's all fairyland. It's not real. So now we may be facing a move to reality, a move to normalize what things are. So let's start with the cost of money. What is the right cost of money? If you have a lot of capital, would you loan it out for 30 years at 3%, 2.75%? Probably not. I'm guessing that the cost of money is somewhere between 4.5% and 5.5% for the highest quality treasury obligations. Can we get there? Our highest quality treasury obligations have been bloodied this year to the tune of almost 10%. And yet the long-term government bond is still below 3%. It's almost 3%, but it's below 3%. And it came from something like 1.5%. But if we're looking at a normal rate of 4.5 to 5.5, that's a long way from the 3% band that we're at right now, and that means bond prices have to drop significantly. And when you use the interest rates that are prevalent in the world to try to derive a value for a common stock and its earnings growth, it's a discounting mechanism. And 21, 22 times on average is too high, especially if interest rates go back to 4 and 5. So that you have to have a value adjustment in the market. And this is what the fear is all about, that there is a crack in the counterparty risk transaction scheme, often using derivatives. A lot of hedge funds and alternative investments, private equity investments are in this area. And when you have a crack in the valuation, when you have a crack in the interest rates because the Federal Reserve is attacking the interest rates, then you've got a process that we'll just call a reset. We have to reset the game. We have to reset valuations. And I'm guessing in a reset, the worst case is maybe another 40% drop in bond prices to get us back to the 4.5 to 5.5% range for long-term treasuries. And that means probably a reset in price-earnings ratios for stocks, and I think there's probably a 30% drop in stock prices that has to go along with an interest rate reset. So if you're looking at -40 and -30 as a possibility, it's easy to become scared where you've got somebody putting so much leverage into a situation, they're manufacturing 150 billion of stock values that aren't there. And the lenders suddenly become in trouble and they become panicked and they start throwing things to the market to sell. So that's what we've got, and that's why you've got an 800-point down day, 400-point up day, turned around by an 800-point down day. It is so volatile. We are almost totally defensive at this point, owning no bonds, because I don't know where the interest rates are going to go. Nobody really knows what the Federal Reserve is going to do. They've talked tough, but we haven't seen it yet. So the word for the day, the word for the month is patience. With adequate money on the sidelines, confining what you do have exposed from a risk standpoint to preserve capital in a worst case, and we have to wait and see. But it promises to be pretty rugged and pretty volatile in here. So hang on, and we'll let you know as soon as we see the Fed. Powell has told us that he's going to increase rates by 50 basis points. Let's see what he does. And that'll begin to tell us whether we're going to have a reset or whether this is just, as they say, where I grew up, whether it's just shibai. We don't know. Anyway, thanks for tuning in. We'll talk soon.